My name is Danny Brown. I'm the CEO of Myriad Real Estate Group, and this is our April market update. One big change that happened between last month and this month is that the Fed, Jerome Powell, came out and finally raised rates. The market was kind of predicting this would happen in March. They didn't know how much. There was a lot of speculation that it would be 0.5%, and then the war in Ukraine and Russia has caused the markets to be somewhat volatile. And so they backed that down and they did a rate hike of just 0.25%. Not really a huge uptick in the Fed funds rate, but it's a start. And what they're trying to do is slow down our economy because the rate of inflation is so high. Don't know if you've noticed, but everything is more expensive out there, from housing to gas to food, like you name it, it's more expensive. And so the Fed is trying to slow that rate of inflation down by making the cost of money more expensive, so that it will stymie demand some. So when demand starts to fall, that will hopefully increase supply, and that rate of inflation will slow. So they are stating that they are going to do 6 more rate hikes this year at somewhere between 0.25% and 0.5%. The Fed firmly believes that our economy is strong enough that those rate hikes will not push us into a recession. So time will tell. And they plan on doing 3 more next year. Now, markets really like predictability. They hate unpredictability. So with the Fed dictating and telling us what they're going to do, it's really caused the market and the economy to be less volatile. So the stock market has rebounded recently. Stocks are in the green, and everybody feels a lot better about things. Now, for your benefit, the Fed funds rate is the rate that banks charge each other to borrow money. And so right in the past, the last 2 years, it's been 0%. So to borrow money has been super, super cheap, which therefore makes the money super cheap for us to borrow as well. And so when the Fed increases those rates, things on credit cards, short-term debt, home equity lines of credit, variable rate, interest rates all start to climb when the Fed starts increasing rates. Now, there's an indirect correlation that when the Fed starts messing with rates, mortgage rates will be affected as well. And so when the Fed raised rates, we saw rates pop on mortgages for the first time since 2018 to above 4%. Now, the thought is that with increasing mortgage rates, that will put downward pressure on demand, because people will be able to afford less, and that will start to slow appreciation. That hasn't happened yet, so we haven't hit that point where buyers are being affected greatly by that increase in interest rates, and I believe that's because there's so much cash in the system. Americans right now are in really good positions, typically financially, because there was so much stimulus over the last 2 years, so people have a lot of money in reserves. And so we haven't really seen a direct impact on that level of demand. You will see clickbait articles talking about how the number of closings are down. That is true, but it's not down because there isn't demand or we're starting to see the beginning signs of the housing market collapse. The number of closings are down is because the level of inventory is at record lows. So there's not enough homes for sale for people to purchase, which is causing the number of sales to decrease month over month. So that is not an indicator that the housing market is in trouble. It is a continuing indicator of how little inventory we have available, that pricing is still going up in terms of appreciation, and interest rates are going up, and demand hasn't changed really at all. When will there be more supply on the market? And this happened just recently. In 2018, the Fed started raising rates, and mortgage rates got up above 5% going into 2019. We saw demand drop, and we saw supply start to increase. So my expectation is that once mortgage rates get closer to or into the 5s, that will be the point at which demand will start to come down I don't want to say significantly, but start to come down to the level where supply will have a little bit of time to catch up. Now, don't fool yourself. Greater Phoenix only has 4,000 homes for sale between houses, townhomes, and condos, and that is a number that I have said month over month because it's true. We're bouncing around between 4,000 to 5,000 properties on the market, and that is just way, way too low for a population of over 5 million people. To be in a balanced market, we should really be closer to 36,000 homes on the market. So even if we do have a slight increase in supply, unless there's a ton of homes coming from somewhere, it's not going to be enough to really transition the market from a seller's market to a buyer's market, but rather add just a little bit of relief to buyers, make it so that they hopefully don't have to make a decision within hours of a property coming to market, and just give them a little bit more options in terms of choices of homes. So we will see if this all plays out. I'm expecting, Q3, Q4 of this year for prices, for mortgage rates to start pushing that 5% range. And so we will see if that happens. Zillow completely disagrees. They just changed their outlook and they expect property values this year to appreciate north of 22%. And they believe that we're going to be next year in the high teens for appreciation. So, we'll see what ends up happening. Nobody knows the future. All I know is that interest rates are going up. Pricing is going to continue to go up. We have very little inventory on the market, and that's really what's driving all of this. Thank you so much for tuning in. This has been our April market update. Please leave any questions or comments down below, and we will see you next time.